What's up, guys? This is FX, and so today I want us to talk about liquidity. And liquidity, this main, I'll say this one of the things that have been a problem mostly when it comes to the market structure. And there's a video that I did on my YouTube, but I think it's not as deep as this one. And I'll still make another video. This is just the starting or the beginning of topics of liquidity, because I think it will be more clear and better off if you guys get to understand how to see or identify liquidity across all time frames on the market structure, and also how to take advantage of it. So as we look at this first diagram here, we can see this just a market structure, right? Of course, this is not like the real one, because the real one is of candles, but this a way of how you can understand it. You see the price pushing higher, creating a low. Remember, an internal structure. When you talk of external and internal structure, there's a way. Let me give you an example here. If price creates a bigger move to the upside, that is external. This is what we call internal, then a continuation. So this is what we call internal structures of the market. So if the price is going higher like that and start doing this is what we call internal structure, then continues to the upside. So what we have at once, we always say that the whole structure is like this, all right? That, all right? So, but that's something for another day. So if the price creates what we call an internal structure, like that, it goes higher and it comes down and it breaks the low here, this low. Let me zoom in a little bit more, like we break this particular low here. As you can see, we break this low. This means that the market itself, it has done what? It has done something like this and took out this low on the left before going higher. Let me use a different color here. This something like that. You're going to see that once you have something like this, you see prices broken the low. This means that if there was a stop loss here or a liquidity, that's where the money is resting. And money rests where the market generates the high or the low on the market structure. For example, the price comes in and goes higher. Of course, price goes up because of pressure of whether buyers, if it's going to push to the upside. But if price pushes to the downside, then it's getting the pressure for sellers. The sellers are up there pushing the price to the downside. So when the price goes higher, most people will put their stop loss here. And if the price comes back and take out that low, this means that there's no more liquidity, there's no money around that zone, and the price has only way to go higher and to collect the money for those who sold here and those who sold at around this area. So price, when it goes higher to the upside, just going to collect all the money for everybody who was selling. So one goes high and break that structure there. Like we get this this particular break, example. We get this break here. That the price has just gone higher to collect all the money for people who are selling. So once it does that, then those who are buying, this is where they have their stops. When they're buying that move to the upside, they'll place their stop loss here. So this means that if you're identifying liquidity, then this is your liquidity zone that you want to see. Price first coming down, collecting that liquidity. Once it's done with the money, then you know where is the liquidity now. The liquidity is up here for those who are selling. So price has now a room to go up properly and again collect the money up there. So that's how you can logically look at the market structure, right? The liquidity is here. And this just for this part of this is how the market look like this. So I don't want you guys to cram, but you can rewatch this movie. Sorry, I was about to say this video, a couple of times, and I'm sure you're going to see something here. So we look at this second structure here. Price, we can see again here, the market will rally to the upside, creates a pullback, and some internal pullbacks like that here and goes higher and still break the structure. Remember, any level that generates liquidity, if the push to the upside must be the low that caused the high, or the high that caused the low. So for example, here we can see the market has kept breaking the structure, some internal structure. Look, the whole move looks like this, yeah, and to the upside. But you can see the market kept breaking previous high, low, breaks the previous high, breaks the previous high, and goes to the upside. So we can see we have some small market structure break here, like you see here. See another one here. You see this one here. Then look at that. There's another one here. You see, so the market has kept breaking the structure, some smaller internal structure to the upside. But how do you look at this market? How do you spot liquidity on a structure like this? Because already we can see the price has gone higher and it has broken that particular structure there. You have a breakout structure there. So how do you identify liquidity here? I said if the price is gonna go up, remember the topic of a pullback, when the price goes higher and returns and goes higher, somebody is placing a stop loss here. So the price, when it comes down, it has to collect all that money, right? And go higher again, and it will do this again, break the structure. Again, there's liquidity here. Come here, collect the money, go higher, break the structure. And you see when the mob market keeps going higher, again, other people are placing the stop loss here, and somebody else is placing the stop loss here on these strong lows of the market structure. For example, price collect all the money here again and go higher, break the structure, and on the same, somebody's bought here. And you can see that among these structures, again, we still contain some stop loss from this strong low here and here. So the market, when it's decided now to collect all these major money levels here, then it will have just to narrow down like that and take out that major structure. Why? Because this structure now looks like this. Look at that. That, and to the upside. Then this is a source, the low that generated all that push to the upside. So the market will need to collect all this money here, right here like that, before pumping again to the upside. So this is just a logical thing. I know it takes time to understand, but rewatch this video a couple of times, and I'm going to make more. If you guys want more of these videos of liquidity, just make sure that you drop your comment on there. You drop your comment either in the group or whatever, it's YouTube or on WhatsApp group, whereby you people are members there, so that I can be able to redo more, because the liquidity topic is very sensitive, and if you can be able to see how you deal with it, it will give you more probability. So you can see on this market structure here, why am I having this level or this zone as a liquidity zone? And again, I'm having this level as a major one. Why? Because remember, when the price goes higher, let's say high, low, high, low, high, low, then you have a high. You see, I've broken this internal high, and the price went lower because this was also a low that generated the high, and price pumped to the upside, right? So here, what are we learning from this? We can see that on this low here, again, price took out what? This liquidity, right? This is the liquidity. And don't get confused between inducement and the liquidity. It's just the same thing. So that inducement is a level that we are trying to make sure that it's taken out, all right? So you can see price wants it to collect money here and it goes higher. This, again, is another level that has collected all the money. So if the price comes back, here, for example, price went higher, and broke that structure there. We broke that area, that zone to the upside. So once market broke that zone to the upside, this means that if went higher, then this is the most recent low after market collected the money. These were most recent buyers are still holding their positions. So this means that the market, if it wants to go up, it needs to take out this particular low, right, before going higher. Okay, it can take out this level and pump to the upside. And as well, if it wants to take the whole move, look at that. Look at this, sorry. The price created this major pullback here. Then all these internal structures, small internal structure, but this way it did what? It collected some smaller liquidity and went higher. So if the price needs more money, remember the institutions, when they are trading, they need liquidity to move their orders. So when they realize that their orders here can't fit, this liquidity is not enough, then they'll have to do what? To go lower for more liquidity, because most people who traded this whole move, majority are still here. So it will come here, collect all the money. Then when the people think that it's going to sell, then we go to the upside, we push to the upside. So understand it. So this one is a major liquidity area zone. Then this is just a minor one that once takes out the level, price will depend on the number of orders. It's likely just to do this and pump to the upside. So that is another way. I hope this one is well explained. So let's look at this one here. On this market structure here, this whereby you just have the normal market creating a pullback, then breaking the structure to the upside. And if there's something that I want you guys to improve on that has misled even me myself for a long time since I started trading, whereby you are told that the order block is on the low that leads to a break of structure. You see, order block on the low like leads to a break of structure. This strong low that leads to a break of structure, most of the time doesn't work. Why? Price will come, right? Then react on this level like that, go higher, and again violate the zone. After this level is taken out, then you'll see price rallying to the upside. So this low that leads to a break of structure, unless you have something, another, for example, another something like that, then a push to the upside. So this can act as an inducement or a liquidity. Then when price takes out that one and mitigate this level, then you have a higher probability to buy from that. But if you just have this level alone, the low that leads to a break of structure, that low, this consider that, know that the market is always moving from one pool of liquidity to another pool of liquidity. So if the price came down and went higher, most people place their stop loss here. This means that if the market's after liquidity, as we say, then this is where most money, because the liquidity is where the money is resting, then this means that the market needs to collect all the money here before a push to the upside. So I hope this one is well clear. Another idea, the only reason you can trade here, but again, there's always a low probability setup, is when you have something like this. Price went higher, all right, then it came to the downside and we did this, something like this, and it comes down, sweeps this level. It has to sweep, not to close with the candle, at least sweep this level, and it can do something like this and go higher. When the price comes back here, there's a little bit higher probability to buy from this zone because already took out the liquidity type 2. Liquidity type 2 is the liquidity that's on your right-hand side. That's something that we'll cover. If you request videos about that, we'll talk about it. So when the looks like that, and they push to the upside, this is a low that has led to the break of structure. The original low that is the source of liquidity. So sometimes the market can come here and react to this because this is an internal structure whereby the price will do something like that and come here and try to buy from this particular zone because liquidity has been taken out, and it will go higher and collect what we call the internal inducement, because when the price was dropping, this is like an internal inducement to collect this one, and later on now pump towards this major low here, and again you get what? You get that push to the upside. Sometimes the market will do this. So you need to be aware that this is an internal structure that you're dealing with, and it's not this push, this major low here. So that's something that, again, you have to be very, very careful with. And that was just my point of explaining here.